Welcome back to the Finance Corner. So, this is the update on our next video of our option series where we're trying to flip money slowly using the options wheel. So, let's get right into what we got going on here. So, as you can see, we are not looking the best as of right now. We are not looking the best as of right now. So, I'll just talk about the trades that I did in between the last update that we did, and then we'll talk about how I plan on moving forward. So, starting with what we did before, yeah, let's actually start there. The actual trades that we did. Um, so here in the history, I think the last thing we did was we started playing around with SMR. So I think it was around. So we had May 16th. Yeah, I think this was around the last thing that I did. So we closed. Yep. So, I think I talked about that in the last one. So yeah, we should be here. So what I did was I've been trying to sell puts on SMR and just using that to kind of like the little money that we have in the account, the cash, been using that to kind of just generate some more premium on it. And so that was the goal there. But we kind of got caught up. So let's talk about it. So basically, this trade in particular wasn't really the best, but it isn't. It was just a small loss, and as you can see here, so we actually sold a $14 put expiring May 8th. Sold it, collected 615, or we sold it at 205, and we got three contracts. So you do the math out, that comes up to 615. But we can actually take a look at the price action. Can actually take a look at the price action for. Oh, trust me, we're definitely gonna talk about coals. Um, but for SMR, we can see what actually happened here. So right here, for the whole of May, we've really just been kind of just chopping. We haven't really been going anywhere. We failed to break 14, which is my strike price, and we just been kind of just chopping around in this area. That contract that I sold specifically on the first, which is Friday here, I think it was on a Friday here. Yeah, so we had a sold this contract here, and then over the weekend it actually dipped below, and so I think that was actually a good play for me to actually close it out because you can see here we actually took a small loss of about, what's that, $60. Took a loss of about $60 on it because we sold it, collected 615, but to buy it back it was actually still around that same price, 225. So I didn't want to get assigned. I think in that particular trade I didn't want to get assigned, so we actually just let it just took the small loss on it. That was around here. We just took the small loss on it, and then but here's the problem. Here's the problem, folks. So I should have just took assignment on that particular trade. I should have took assignment because if I remember correctly, we sold the $14 put and it collected 205. Our cost basis would have only been like 11.95. I don't. Does it show it here? No, it doesn't show it here. But if you do 14 minus 205, your cost basis only comes out to 11.95. And so as you can see, where is it here? On this particular candle, Monday, we would have been able to actually, like, it popped higher than 11.95. See, it had a high of about $12.45. So if I took assignment, I actually would have been able to still make some money off of that. But I got scared, chickened out. I decided to just close the trade and take the small loss. But that was ideally what I should have done. Just took assignment and then just sold the shares on Monday. Um, that was that trade. And then here's the next thing that we did. So we sold a $14 put, or a $14.5 put. But the problem with this one is we sold it when the price was way too high. So you can actually look exactly, see what time price it was at 5:11 at 11 a.m. So May 11th at 11 a.m. I actually might have to go into the hour chart for this. So look at how bad this was. 11 a.m. is here. So on this particular candle, hopefully you can see it. This particular candle, the price was as high as like 13.30, and that was about the time I opened it. I started at the open, so I sold it at $13. And you know, if I sold the $13 put with a $14, sorry, if I sold a $14 strike price put and the current price is only $13, like we're not really gonna collect that much in premium. So here you can see we only collected $1.63. Mind you, this is a lot of premium, but it's like this is a lot of premium because of the high implied volatility. Like the implied volatility on the SMR has been over like 100%. So with the volatility that high, they're going to naturally pay a higher premium. But since it was actually closer to the strike price, we could have waited a little bit and collected a lot more in premium. And that was the issue. That was the issue there because as you can see, let me actually highlight it here is around the price that I sold it at. Um, and then mind you, we got a $14 strike price. We sold it here, and then look what happened immediately after. Price just dumped. Price just dumped, and then we didn't really get back to that point. We just kind of been on a downtrend since there, right? And so yeah, that kind of sucks. That kind of sucks. So that kind of leads into what happened to today. So I sold 4 contracts here, but remember this count has a little bit of margin on it, and but that was too. What's the word? I was too over leveraged with 4 contracts, so I just decided to just sell one and keep 3 contracts, which is better because we actually did end up getting assigned. So if we can do the math out here really quickly, let's do some quick maths. So we sold a $14.05 put, and that was the other issue. Like for some reason, I just had the idea that like we're gonna get this breakout, but I to this week was just poorly executed overall. Like I had very little patience. I just decided to just write the new contract after I closed the old one instead of just waiting for the best opportunity to do that. So we kind of just got assigned at like the not favorable price. But let's do some quick math here. So if we take a $14.5 put strike price minus the $1.63 that we got paid, our cost basis is around $12.87. So as you can see, our cost basis is $12.87, but current price is actually $11.23. So take our handy dandy measurement tool here. So if the we're actually down on these shares currently about 12%. What is that? 13%, 12, 13%. So it is what it is. I'm bullish on this company long term. So it's all right. It's all right. It's like the only problem is with the failure of breaking out, we kind of like I wonder how low this thing is actually gonna go before it like bounces. Uh, so yeah, that's kind of like the only issue. But since we have shares, like we have shares on margin though, so it's like now we're kind of at risk of getting margin called if it actually drops way lower than this. So hopefully that doesn't happen. Hopefully that doesn't happen. Again, poorly execution on this week. Like the market has been, you can see like to close the day we were down like 6% on SMR, and like the market overall is just red. Like look, Nvidia is down 4%, AMD is down 5%, MSTR is down 5%. Um, you know, not a good close in the market. But there's a lot of things going on. So I know that Trump went to China with a bunch of the top tech CEOs like Bezos and Jensen Huang. Um, CEOs of Palantir, MU, all these top big CEOs, they took a trip to China to try to make a deal with them. I think that happened this week. So hopefully the market, and I think we did get a deal. I think we did get it. They did get a deal. I don't know the specific parameters of that, but it should be very interesting to see how the market opens this Monday, which would be the 18th. So that's kind of where we're at. That's kind of where we're at. So as you can see, we're on the account itself. We're down significantly. We are actually down significantly. Um, so as you can see, currently we're holding 300 shares, cold shares of Coles and 300 shares of SMR, and we kind of just gotta hold on. Kind of just gotta hold on for it. Hold on to it right at this point. So if you could just click on that. This is exactly, no one gets more transparent than me. You'll see the ups and you'll see the downs. I I really am disappointed in my just decision making this week. Like, look, you see we're down about 41% on Coles. Not good at all. Not good at all. And then if we go back to, I think one thing I wanted to, so I'll talk about that real brief. Why I don't mind holding Coles for a little bit longer is because, okay, here it was. One of the things, so if you actually take a look at, do some research and take a look at Coles, like what analysts are saying about it. I was doing some research and I seen that what was it? This article here. It basically just talks about why why Coles are down like 10% in that day. It came out the day of this big drop, and that was really because if you're thinking about the state of the economy right now, it's like okay, energy prices are very high, and inflation is actually very high. So what does that two combination of things means? It means that if people have to pay a lot more for gas and a lot more to heat their homes and a lot more for everyday stuff in general, like the necessities, that's less money that they have to actually spend at retailers like Kohl's. Because remember, Kohl's is a consumer discretionary stock. So it sells like apparel and jewelry and like, has stuff in Sephora and stuff like that. So it's like investors aren't really looking too optimistic at that because of the state of the economy right now. People have to pay a lot more for gas. They're not spending money at Kohl's. So that's kind of where we're at here. But one of the things that I looked at to kind of like counteract or see what the bulls are saying, I kind of like how, where is it? There's a lot of buying, there's recent buying volume. So as you can see here, as the price is kind of coming down, there's a lot of buying volume, at least on Robinhood specifically. So I do have the Robinhood Pro, and the what is it? The like I'm paying for the service or whatever, so I get to see all these cool things. And one thing that also stuck out to me is like at the end of 2025, there's been a lot of actual hedge funds actually buying it around the price of like $20. So I mean, and then in Q1 they've been buying it a lot at around the price of $12. So then there's the insiders, which is the actual people who run the company. This is actually what you want to see. This is kind of the biggest like green flag, I guess, for me to kind of hold on to Coles for a little bit because um like they're actually buying a lot more in volume. You can see this March and April. So in March, they've been buying around the average price of $12.90. In April, they've been buying around the average price of $14 with a lot more buying volume. So my thesis here is that if we come back to the price chart, we should kind of have like um, a support. Like I genuinely believe we should have support below here in this area. Now I could be wrong, mind you, I could be wrong. And this week, my decision making has not been that on point. So it's like I could be wrong, but I think that just with the insiders buying, and I think that we had slightly less short float or short interest. So yeah, here you can see the price or the stock was actually being a lot shorted in early May and late April, but now it's not being as shorted. So as we had a short flow of around 27% for all of April and early May. Now it dropped a little bit to only 23%, which is kind of still a lot. Like 23% of outstanding shares are being actively shorted. So it's like, you know, hopefully we actually see a support being established around this $12 or $11 to $12 price. That's kind of what I kind of want to see. I'm kind of too like I'm already like knee deep in it. I really don't want to lock in the loss for Coles, like $2,000 loss. I'm not really trying to lock that in. But when it comes to, so that's where we're at for Coles. I'm literally just still holding it. We do have earnings coming up, I think in like 2 weeks. So that can be a positive catalyst. You see, like right now, they're expecting a negative earnings. Um, so a small loss in profits. But compared to the last, like if they beat earnings, I can see the stock actually popping because the guidance is actually negative. So they're expecting Coles to actually lose money for this period. But if they come out and actually surprise, that should give the stock a nice pop. I believe it should give the stock a nice pop. But let's see, because it's all about the narrative that's forming around this company right now. And I'm also interested in seeing how the summer is going to play out because school's just ending. People's gonna be outside. People are gonna want to go to Sephora, buy their jewelry and all that good jazz. So I want to be optimistic about this, but also not too blindsided by like the optimism, right? So that's kind of where we're at. And then let's talk about SMR really briefly, and then that's kind of where we're at here. So right now, the 300 shares I have on SMR is at a 1287. Let me actually get rid of these boxes. I remember the last time I was talking about like if it ends up in this range, like we'll be fine. But now it's a completely different story because I have new contracts. So my cost basis actually, yeah, that's why I wrote this out here. 1195 was my cost basis for the other one, which I should have just took assignment on. But now here, Friday, May 15th, our cost basis is all the way up here at 1287. 1287. So let's see. Let's see what happens. I kind of don't like what I don't like are these gaps down here. I don't like are this particular gap around $9. I don't like it because it looks like that could be an area that price comes down into. Um, yeah, that would be not so good. That'd be not so good because I'd be down even more. Let's actually draw that out. If price has to go that low, I'd be down. Well, actually, no, that's not accurate. I would be down a whopping 25%. Isn't that exciting? Like, don't you just love losing money? But that's kind of where we're at. That's kind of where we're at now. We're just gonna be holding on to these shares. Hopefully, we get a nice pop, be able to sell some covered calls on it, or just straight up sell the shares and get rid of them so I can get my money back. But yeah, and actually, I forgot to mention, I have a newsletter where we are talking about wealth building strategies, risk management strategies, and just overall keeping up to date with the market. If you'd like, feel free to sign up for my newsletter for free. You just get all these insights dropped straight into your inbox, and then you can read it, stay up to date with what's going on. It's called Investor's Lens, and yeah, I'd appreciate it. Thanks for watching.